Welcome to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome to our Avenue first quarter 2026 podcast update. We're actually well into the second quarter now. We actually had a very busy tax season, but this is the first time we've had to get together. And really it's just to highlight just an extraordinary stock market that we're in. There's a lot of times that there's, a lot of sort of stocks move together and there's themes in the stock market. But right now we have an awful lot of overlapping, contradictory things, and we really thought Bryden and I today will try to attack it head on. Just as a quick summary, it's really just to say that, it's, first of all, just to remind everybody that we really feel that because of what's going on with all the money in the financial system, you do actually have to own something. And we always look at it like we own businesses. Yes, there are stocks that trade on the stock exchange, but we really try to pull them apart. Are these numbers? What are the business models? And we really try to own these high quality businesses long term. But right now you've just got all these other trends and currents that are just sort of absolutely moving stocks on the stock exchange in all sorts of extraordinary ways. So always remembering on the positive side, there's a $2 trillion budget deficit in the US, which sounds like it's that's a thing to get nervous about. The only thing is when it comes to financial assets, because there's a massive budget deficit, there's extraordinary money in the financial system. The other one is this artificial intelligence build out. There's an extraordinary CapEx boom, and we've been able to take advantage of that in the portfolio. And there really is an amazing amount of money being spent, and it is real. So those are the positive sides of the market. On the other side of the market, where you can get nervous about, my God, there's just an extraordinary long list. Where we're talking war in Iran. Is artificial intelligence actually a bubble? We can discuss that. There's headline news on private credit, the problems in the big banks in the U.S. and in the funds, which is in the private credit market. And then we also just want to touch base on, all the noise we had over a year ago on the tariffs in the US. We still have an awful lot of noise on that in the stock market, and tariffs take a long time to sort of hit the actual business cycle, and we're actually seeing that come through very gradually in inflation, even as we're talking this week. So that's sort of the background, and really the fun topic we like to hit today is on risk management in the portfolio. Spend an awful lot of time finding these businesses, trying to own them, let the stocks compound. But when you get these, very divergent markets, this is when that always the final part of portfolio management is what is your risk management process? And really that's what we want to talk about today. And we're going to hit those first items just to really talk about those other big trends and currents here. We're going to hit that first and then talk about just how we're addressing risk management in the portfolio. So I'll throw it over to Bryden. Loved again your quarterly letter. That was a great way to sort of set up. These are the big themes that we're all challenging with, and these are the themes that everybody's reading about in the newspapers. And I just thought we could, first off, before we get to risk management, go through them one at a time. And back from what we've found running looking after the investments in the portfolio with everything with the U.S. and Iran, and how's that affecting what we're actually seeing.
Yeah, well, I think the other way, and what we talked about previously on this, is just that it's almost like you've had a year's worth of news in the first 4 months of the year. And I think we've had almost multiple different major news cycles and major geopolitical events happening in the beginning, first few months of the year. And then the news cycle in the last month has changed again. I think what we try to highlight in the letter is just to frame exactly the three risks that you talked about. Specifically with the war in Iran, I think the most direct and observable impact of that is clearly the gas price that people are paying at the pump. And whether it's in the US or in Europe or in Asia or, for clients in Canada domestically, everyone can notice the price of gas going up. And I think because we're now in this stalemate situation where essentially the supply of oil from the Middle East is still being curtailed, as long as that supply is not hitting the market, you're going to have this upward pressure on prices. So that's the first impact. I think, we try to avoid becoming geopolitical analysts about potential outcomes with the war, but we sort of take it at face value that there is a war. It is ongoing. It is likely to continue ongoing in some form. And so because of that, these cost pressures on commodities and energy are likely to continue. And that's sort of I would say our base case analysis of the situation, which is we try to keep it as simplistic as possible. But I think the next step of it is important, is that given that condition where commodities are higher, energy prices are higher, what is the downstream impact on that, either positively for a business or negatively, and how are we exposed to that in some of the businesses that we own? So we're always taking what is a geopolitical event or a situation that is unfolding, but then ultimately what we always try to bring back, and we try to do this in the letter, is how does that impact what we own and why? And do we need to revisit things, or are there opportunities because of the situation that's ongoing?
Maybe I'll add something there, just because, as you say, from a portfolio point of view and owning energy businesses, really what that's saying away, making it simple, I think it's the way the stock market values these companies before the war in Iran, and as you said, this might have a long tail to it or just take a lot longer to resolve, is that the stock market was using about a $65 oil price to value the stocks that we own in the business. Now that has jumped, the oil price can be over 100, but the stock market is now valuing these businesses as if we might have an $80, $85 oil price longer term, and that's what we'd call a re-rating of all the stocks in the stock market. And you can look at that headline number on oil, and that just moves. That's fine. That's what everybody's focused on day to day. But it's the re-rating of the stock market, which a higher, longer-term oil price. And I'd also say that it's amazing how fast-moving this is. We went through we have some fertilizer exposure in the portfolio, but also even on the base metal copper side. This week it just came out that sulfur and sulfuric acid is constrained. This is just this other byproduct, but now it's not getting out, and that affects global copper production globally, and then copper takes off. So even though there's all sorts of things to be negative about on the energy side and on the base metal side, it's just everything's actually quite positive at the moment.
Yeah, and I think the other takeaway is that, and we just sort of always try to approach this with the humility of there's only so much about the situation that is knowable and observable, and I think we're in a world where it seems like everything should happen overnight. So if A happens, then B cause should or effect should happen the next day or week. And I think the challenge with the current situation is a lot of these impacts are still in the early phases of unfolding. And so I think that whether it's, a byproduct so that base metals can't be turned into end products, whether it's fertilizer prices starting to raise the price of food, I mean, all of that news cycle has almost come and gone in the last month, but the actual price impact of that still might be 6 or 9 months or 12 months out. And so I think there's we're trying to have a patience to these impacts or potential impacts of the war, because I think that all of this will take longer to play out than I think the news cycle has patience for. But ultimately that will then affect the underlying business results, either positively or negative. And it's something that we have to be watching very quickly on that, or very closely on that. The second part of the risks that we highlighted,
here, I'll throw it back. But yes, AI is the elephant in the room, and as I said, these very narrow group of stocks. I'll actually frame it just from my stock market historical perspective, is that this new thing comes along. It's an extraordinary event. Everybody knows it's going to transform in some way, but there's not very many ways to play it. And I just like bringing up the point: everybody on the planet wants to have exposure all at the same time, but it's not like it's not sort of based on, what's the long-term business outlook, what's the valuation. Just like none of that matters. They're just driving in and driving these stocks, and it's just a narrow group of stocks that's pushing the overall indexes. But you actually wrote a great analysis in just how we're looking at it.
Yeah, I think, and essentially the challenge right now is just that you have this sort of all-out race for AI supremacy, and essentially you've got different parts of the technology space that are spending unlimited amounts of money, and you're now this has been happening for a couple of years, but we're in the last 6 months it feels like we're at the acceleration phase where it's almost you're racing towards essentially spending unlimited amounts of money if you're a large technology company, because the risk is that if you don't, one of your competitors is going to eat your lunch. And so you've got this desire, and almost the animal spirits in that sector are just like throbbing right now, which is fascinating to watch. I think the one thing that we've tried to do for the last couple of years is figure out what parts of or what industries or what businesses that are benefiting from that spending, but at the same time aren't dependent on the risk that a lot of this investment doesn't end up generating a return. So the idea would be, a technology company can build, spend $100 billion building data centers. That investment from that company might make no money in the long run, but the data centers are still being built. So are there companies that are part of that construction cycle or industrial cycle, whether it's power suppliers, power producers? A company that we've highlighted maybe 2 or 3 letters ago, Toromont, so the largest Caterpillar dealer in North America that's publicly traded. They've benefited from the fiscal spending that's happened in the last couple of years. And a year ago when we met with them, they had recently made an acquisition, a Hamilton-based company that did distribution for essentially the part of the power component that would go into these data centers. And remember, if we could remember this 2 or 3 years ago, we were sort of scratching at our heads because Toromont just kind of was stuck there. And the conversations we had internally is, are we missing something? But again, it took almost a year and a half for this cycle to kick in. And then again, that's a business that's really benefited from this larger AI spending.
Yeah, I'm just going to throw, like, following the dollar, sort of a way of saying it, is historically, and we'll pick on a stock like Facebook, which we've tried to own in the past when it was incredibly inexpensive stock a few years ago, very hard with the volatility to get it, and ended up not being a successful investment, but without any significant loss. But where Facebook made tons of money, there was nothing it could do with it. And so it would buy back stock and sometimes go into other businesses. This time, the extraordinary is they're spending hundreds of billions of dollars and they're actually borrowing the money. So suddenly, Facebook actually doesn't look like a good business. I will say, trying to define something as a bubble in the stock market, you usually only know about that after the fact. But usually a bubble has something to do with borrowing money. It's not just because stocks go up a lot isn't a bubble or definition. It's usually, you financed it with debt, you got caught, and that creates the cascade on the other side. So now we actually see these big tech companies taking on debt to build out their infrastructure, and we want to be on the other side of it where that actual dollar comes to us in the construction phase, in the energy phase, in the electricity phase. We are trying to take benefit. You're just not in those red hot stocks that are borrowing tons of money.
Yeah.
And just where it's very hard to figure out. Okay, we don't have to go too much on that.
Yeah,
but
no, but I think, that feeds into the idea of risk management, the general topic that we kind of highlighted in the letter, and you led with the introduction. And I think the idea, again, that we have with every investment we have in the portfolio is we have an idea of why we think it's a good business, why we want to own it, but we also have this idea of where might we be wrong and what do we have to look out for. And I think in a market like this, where you do have individual name volatility, or individual stocks are trading up and down very erratically every day, you have to have a risk management process that you adhere to, because it's very easy to get whipsawed. Vice versa, a month and a half ago, everything was negative. The war was on. It seemed like it was spiraling out of control. And then a month and a half later, that doesn't matter anymore. And all of a sudden the money's rushed back in. And so what we always try to do is sort of bridge our process so that we're allowing businesses that we've owned for years or several years to continue to grow. And it's almost, sometimes we joke about it being the quality trap, where we go through what we own, comparing it to the rest of the sector that it's in. And we usually emerge from that saying, well, we own the highest quality thing in this sector. And so in that case, a lot of the time, the right thing to do is nothing, except let the business continue to grow and sort of show its resiliency. On the other side, where we scrutinize investments much more quickly, is on new investments. And so on a new investment, if it's not working out or something changes or we've misjudged sort of the situation or the valuation is not low enough, the leash is much shorter at the beginning of an investment. And we think that risk management balance of letting your successful businesses continue to grow, maybe taking profits, but ultimately we would love to collect a full portfolio of businesses that we don't have to touch, or we're just sort of pruning. But in a market like this, I think we've been much more focused on more recent investments and are they working or not, and then having a very disciplined process around that.
Well, why don't we touch on that right now and finish off on the topic of risk management, because it's really just two main points. That is the first one, the rigor in terms of how you initially make the investment, and then also how you hopefully let it breathe and then monitor it. But I would say the most important point that you talked about in that is it's the size of the position is the first part of risk management. And it's not necessarily even that I'm so incredibly confident in this, you never quite know what's happening. And so a lot of the position sizes are sort of given a sense of what the risk is with the investment, and knowing is it, we've let it run and there's the valuation kind of extreme. So I think, as you say, going through the portfolio and a lot of those consumer industrial names in the US, I think we really feel that the position size, a lot of times saying, oh, are we taking any extreme risk? And again, just having the answer, like our thoughts on what the position sizes are.
Well, I think, and on that note exactly, or specifically, we sort of had this sort of moment at the beginning of the year where we had talked about this maybe 2 podcasts ago and a few letters ago. The biggest part of our portfolio on an individual name basis had grown to be a few of the gold companies at the beginning of the year. And so we have a band at which we allow things to breathe in terms of position size. When something has gotten above that band, that's sort of our initial trigger to say, do we need to resize this? I mean, ultimately, and I think where we try to have flexibility, because the last thing you want to do is take a really good business and sell it early just because it's gone up. But we don't want to have positions grow to be too big of the portfolio, because again, it's again always thinking through what could go wrong. At the same time, we're trying to be very sensitive to tax efficiency of long-term compounding, which is essentially collect great businesses, let the after-tax compounding occur. But to do that, you have to avoid sort of excessive pruning and trimming of positions, because then you're giving capital gains on every sale, essentially.
Right. But the other, so that's one, and then 2 is the hard stop, which is in sort of this. We always try to say in these pieces, just not using technical or industry jargon, but there is a stop loss process, and that's the formal term for saying there is actually a hard line where, again, where we'll if a stock isn't doing what we'd hoped it does, where we reassess. But there's also just like, this is not working.
Yeah. No, I think like we're very, very clear at the outset of every investment, and we have it written down of this is the initial purchase price and here's the stop. I think that what we've experienced the last number of years in sort of thinking about the process and how we can sort of make it more explicit. The situation where you can have a stop in your head, I can have a stop in my head, our colleagues could have a stop in their head, but unless it's sort of tangibly written down, explicit, there's ways for your mind to play tricks of, well, the stop should be a couple dollars lower, or it should be even higher because something happens and your mind overreacts to it. So the more explicit we are with the stop level, which we write down at the initial position size, it just makes it a real monitoring situation where you know at what point, okay, it wasn't working. I think the challenge right now, or what we've had looking through some of the more beaten up sectors in the market, where we're looking at software because there's a number of great businesses that are being thrown out, but at the same time we cannot be willing to, and we're not willing to just ride things down because we have some conception of what we think a business is worth. I mean, we have a fundamental view of a business, but we also have a risk management overlay to that, which is critically important, because one of the principal things about investing and long-term successful investing is don't lose money. And so you have to have the humility to look at where you're wrong. And the market right now is in this phase where software businesses or anything that is potentially disrupted by AI is either, at a minimum at the point of having its earnings multiple contract. So you're having an earnings compression or multiple compression. We haven't got to yet the point where a lot of
that's again, earnings multiple compression, but they're jargon. I'm going to straight up that one. They're just like, they were expensive. Here's $1 of earnings, and the stock market said, I really like that company, that business. This is the way of the future, and everybody gets excited. And it's expensive, and so one is they're coming back saying that, like, if a historical stock market trades at 15 to 16 times earnings, but these software companies just like, wow, they got really expensive. It's the market is repricing that because they're nervous about artificial intelligence.
Yeah, and actually, I just 30-second tangent on that point, but I think it's interesting and relevant. Is sort of this comment was made to me by a friend the other day, but essentially what's interesting about that space that's now being disrupted by AI is that in the 2010 to 2020 period, when economic growth was so stagnant, governments weren't spending. It was a very slow growth, low inflation world. What happened is you had a decade where the stock market was willing to price any company that had a lot of growth at incredible valuations because
but paying a lot for the future.
Paying a lot for the future growth.
Today, don't care about it, but I care. It's infinite. I can pay a huge amount for future earnings.
And the market was willing to do that because they couldn't see growth down the pipeline. What's changed in the last 5 years is you have both this dramatic increase in government spending into the economy, and then you have the spending from the AI center and AI sector, tech sector, and data centers, which is spending enormous amounts of money into the tangible economy. So those things changed dramatically in the last 5 years, and so companies are benefiting from that, and some companies are being harmed by that. Like there's now a lot of nominal growth in the economy out there, and I think our portfolio largely reflects that. But the market is no longer willing to pay these very high multiples for what were previous fast-growing companies. What we haven't gotten to is the point where AI actually disrupts the profitability of this business, which it might happen 6 months or 12 months from now. It might happen in the next 2 years. It might not happen at all. That's sort of the dilemma and the quandary that we're going through, and trying to understand what parts of the software sector have very durable earnings. Because if you were just to put every industry side by side, the software company is more profitable and higher return than anything else. The question is that return and profitability durable? And the market doesn't know. We don't know for sure, but we're trying to assess.
Somebody else is going to put them out of business. Somebody else comes up and says, that's great, I'm going to compete with you, I'm going to take away that profit margin.
And
that's what
essentially the other challenge,
always watching.
Again, as you highlighted earlier, there's some software companies that did turn to debt to do buyback. So a leveraged software company that is being disrupted and has a lot of debt, that's in the we don't know bucket. But there's a lot of tech companies and software businesses that are very profitable. The market doesn't like them right now, and that's okay, because I think that's sort of where the opportunity set is for us to be looking.
I think I'm going to use that as a segue into our final point. We'll finish up on this, because we do, for a lot of our clients that have our Avenue corporate bond portfolio, essentially a Canadian corporate bond strategy, and there's a lot of headlines right now about its private credit crisis. And I think as you just touched on it, where historically I would have said that, certainly banks don't lend to software. And then with this private credit, it became, it's hard to say like a financial trend becomes sexy, but all this money sort of, smart or hot money went into the private credit world, which is something we don't do. We were just observing, just say, this all seems kind of crazy. And a lot of it went into, giving debt to software companies. And now that's a big issue. But I think what we just want to highlight, and what you did very well in the letter, is that is, we're in one part of the bond market, and this is a whole other sort of created part of the bond market, and just sort of highlight that it's actually a financial risk, but it is not a financial risk that we're actually saying. I just want to throw it back to you.
Yeah, no, I think
that topic.
I think the private credit issue and private equity issue generally, I think, has been more magnified because of the software exposure, which was not well sort of wasn't in the ether. Like, I didn't know how much private credit had lent to software until it's sort of come out in the last few months. I mean, I can understand why, again, you're doing a private credit issuance, and you think the software company is, is safe and profitable. But then again, we're in a scenario where things are being disrupted. So again, it's a small risk in the banking sector. I think it's very different than 2008. We're trying to avoid a hyperbole around that. But again, it's a concern. And I think anytime investors, or you see funds starting to get locked up, that's sort of an issue, a brewing issue potentially, if you do have a market downturn. I think that's sort of the general synopsis of the letter and what we're seeing out there. Were there any other topics?
No, I think that's great.
Yeah.
I think that's actually really tight. So
Okay.
there you go. We'll look forward to in the, a couple months from now, and there's just certainly, it's amazing how much going on.
Yeah, no, sounds great.